Hello, it's Larry Gaines from Options on the Open. In this video I'm going to go through the market cycles and show you where we currently are at on basic cycles and also where we're potentially headed. And I'm going to also go through and explain to you the Bernanke Put and how that's currently affecting the market and creating a lot of confusion. But before I get started, I wanted to make sure that you've received my free ebook and that you also get my free educational videos. And to do this, just go to my homepage at optionsontheopen.com, put your name and email address in, and you'll get my 15 option trading strategies, which will be very beneficial and helpful to you. So I've got a lot to cover, so let's get started. Now this first chart will be the S&P 500 cash market index, and this is a monthly chart. And with the power cycle trading model, we will go through what we call top-down market technical analysis, and we'll start at the top using a macro point of view, and that is used based on a monthly time frame. So each bar here that you see represents one full month of data. So that's where we start. Then we will go down from the macro to the long term to the medium term, and then we can go to intermediate and short term. But for this analysis, we were going to start right here with the monthly or macro view. And what I'd like to point out is that the markets are currently in a very confused state. The power cycle trading model, we have the macro cycle turned down, and that happened at the very end of June. We currently have the long-term cycle up, and the medium-term cycle is neutral. So as you can see, the broad market picture is very mixed, and this type of mixed picture is largely due to what many in the markets call the Bernanke Put. Basically, the Federal Reserve is trying to, and doing a pretty good job of it from time to time, of manipulating the markets by keeping rates so low that it forces investors to look for better yields for their capital. And for them to basically do that, they need to be are being forced into buying equities because they have the better yields based on dividends and potential growth than you can get on a treasury bill. The problem is that they've been doing this now since 2008 and pretty much have expended a lot of their financial and political capital when they went through the first QE1 and QE2, which were positive for the stocks but were also very detrimental to other areas of the market. You know, basically it was an inflationary policy which really pushed the energy prices up and other commodities up, driving prices higher and hurting the consumers. So, you know, the Fed on Friday, and I'll show you this as well, basically is trying to hold the markets up. And to do this now, they're starting to leak different little reports and rumors that QE3 is coming in, and they're floating that idea out there whenever the markets go down real hard, and then you'll see the markets burst back up. So with this constant ebb and flow of the markets, volatile moves down and then maybe a leak from the Fed or somebody else and it pushes it back up, you get a very volatile and mixed market picture. So I'm going to go through this and show you graphically, you know, the picture and what potentially is going to happen. So again, here's your monthly time frame, and we use this as the macro. Now this particular model, that the power cycle trading model, it's a cycle price model, and when it's overlaid with these different time frames, it will give you various setup situations where it'll show you where cycles are changing from either up to down or down to up. So if you look back over the monthly, now these arrows I put in to indicate, to show you where the setups or entries or the cycles shifted from here into a major downtrend, this red arrow here, which came back in at the very end of 07, to here where the markets turned back to the upside, which is in green, and the yellow, which is in neutral, where it means that the markets potentially were going sideways, so it got out. But as you can see here, the cycle model that I've developed pinpointed the cycle downturn back in at the end of 2007. It has you out of the market until early 2009, got you back in, got you back out to go neutral or flat back in 2010, shifted back to the upside in July of 2010, had a nice move up into June, July of 2011, then cycled back down in 2011, and then back in October, moved back up, and currently the cycle trend has shifted again to the downside. So this is the macro picture as measured by the monthly time frame. Now the next one I'll show you is the weekly, which is the long-term time frame. Now this is the same SPX, which is the cash market for the S&P 500, and the current market trend here on the SPX as measured by the weekly, which is long-term, is currently in an uptrend, and this uptrend started right where this green arrow is, and that was back middle of June. So we're currently, the cycle is in an uptrend, and we had this one large bar down this past Friday, which was July the 6th. So you can see where it's been. It went neutral, then it was long. You can see where it went to the cycle down back here in April. So these are the various entry points for cycle highs, cycle lows, and this is where the model got in for long-term trends. Now also, if you overlay Fibonacci retracement from here, this low in October, to the high back here in end of April, you can see that we've had a correction on a long-term basis down to the 50% retracement level right about in here, which came in, it stopped right here before the 1250, which would have been the 50% retracement. A lot of times markets, when they start in their cycles, they usually tend to not bottom out until the 618. So if that is the case and it falls back through, this market before the end of the summer still has potential to get down to 1200 or 1210, which would be the 618 retracement. So we're currently, in July, and markets tend on a seasonal basis to adjust and to be very volatile during the summer months from June all the way through August or even September. So there's still plenty of time for this market to have all kinds of gyrations, sideways to up to down. But with the seasonality weakness of the summer months, there's a good potential that it could retest down here at the 618. So the next chart I'll show you will be the medium term as measured by the daily. Now this is the S&P 500, the daily, and you'll see here this is the medium term time frame for the cycle indicators that we use, and you can see here the various different cycles that it's caught. Here's a cycle down back in May, caught it all the way down here to the bottom, went neutral about May 21st, then went long, then went neutral again on this down move in June, then went long again early June, all the way up here. So you can see it's been just all over the place, and that's based on the confusion, based on the market turmoil and the volatility that's been created with Europe and the Federal Reserve. So currently, if you just want to get a picture of in the medium term trend, you put your Fibonacci level in here at this June low, extend it up here to the high that was made at the early this weekend, July 3rd, and you can see that the price action on this past Friday, July the 6th, got down here to the 236 right here, held, and then bounced back up. So typically, we should probably get a retest back at least to the 382 and then see what happens. And usually you can also see that the markets tend to have some type of bottoming impact, a lot of times more so at the 618 than at any other Fibonacci level. So that 618 would come in around 1308. So keep in mind this particular picture, review these charts, and the current cycle model that we're using currently has the market in a neutral position here based on the daily or medium term time frame. So what does all this mean for you as a trader or an investor? Well, the bottom line is that, again, I mentioned this earlier in the video, is that you have seasonalities to these markets, and then you're going to have major gyrations that occur within the seasonal patterns. And what we're seeing now is, the summer months, they say go sell in May, go away, tend to be, from a fundamental standpoint, weaker times of the year, and then the markets tend to pick up in the fourth quarter, first quarter. So it's a weak spot for the markets. And then when you have all the current situations that we have with the debt problems in the United States, the European debt problems, and the global slowdowns, you're going to have a lot of gyrations. And then when you have a Federal Reserve that I mentioned earlier, tries to manipulate the market, you can have some big volatile spikes. So what you need to do is, be more so of a cash flow short-term trader, and be very restrictive on what you're doing on a long-term basis until we get through this seasonal period. And you need a good system and a good discipline in order to trade it, which we do have at Options on the Open using the cycle model. So let me go back and show you just the past 2 years, and you'll see exactly what I'm talking about as far as the market's moving up and down, and then eventually find a bottom, but it tends to take several months. So hold on, I'm going to go back and I'll start with the markets in 2010 to give you an idea. So here's the daily or medium-term trend chart of the SPX, and this is 2010. So you can see in April 2010 at the end had a crash, came all the way down, had this one point here where it bottomed in May, shot back up, came back down, shot back up, came back down, shot back up. So you had a cycle down, and in just a few days, vicious move down, vicious move up, down, up, down, up, down, up. So you can see the volatility that these markets have been created are going through, especially in the summer season. So you have May through what I mentioned, September, and then you had a bottoming out in September 2010. Now I'll go through to 2011 and show you. Now here's this chart, same chart. This is 2011, and you can see here in March you had this big move up, and then when you got in here to May, here we go again. Just a waterfall down into June. Then you had this huge spike up into July. Then another big cycle down, an intermediate term cycle down, and then it just fell off the cliff. Major waterfall into August. And then look at these moves. Up, down, up, down. I mean, 1, 2, 3, 4, 5 different kind of cycles, highs to lows, all the way into October, and then it finally bottomed here in October and had this big move up. So that's kind of what we're experiencing now. So in order to get through these type of volatile markets, you need to have discipline, and you need to have a good system and good rules to follow. So if you'd like to learn how we trade at Options on the Open using the Paracycle trading model, please come join us, and good luck trading this coming week.